For as long as modern society has existed, one comforting belief has been passed quietly from generation to generation. Put your money in the bank, it's safe there. It is a sentence so familiar, so logical, so embedded in our cultural memory that few people ever stop to question it. Banks, after all, are the pillars of stability. Marble floors, steel vaults, formal suits, polished counters, everything about them seems designed to project the idea of safety. But history, when examined honestly, tells a far more complicated story. A story filled with collapses, panics, sudden losses, broken promises, and entire populations discovering that the institutions they trusted most could fail them at the very moment they needed protection. This tension between appearance and reality, between the myth of absolute safety and the truth of systemic fragility, is exactly what we are going to unravel today. Welcome to the Economic Rewind Vault, where we step back in time to discover the truths that shape the financial world we live in, and if understanding how money really works helps you make better decisions. Consider subscribing, because the history you are about to revisit may reshape the way you think about your own bank account. The modern image of banking is clean and reassuring. Depositors bring money, banks store it, and the system safeguards it. But this picture, comforting as it is, simply does not reflect reality. When you deposit $1,000, the bank does not place your money in a secure box bearing your name. It does not keep it untouched or readily available. Instead, it lends the majority of that money to strangers, home corporations, governments, hedge funds, while keeping only a tiny fraction in reserve. Sometimes, especially in modern systems, that fraction is effectively zero. This fragile structure is called fractional reserve banking, and while it has powered economic growth for centuries, it also contains the seeds of collapse. As long as people trust the bank, the machine runs smoothly. But if trust evaporates even for a moment, the model falls apart instantly, because when everyone tries to withdraw their money at the same time, the money simply isn't there. And history shows exactly what happens next. It may be surprising to discover that bank failures are not the exception, they are the rule. They stretch back nearly 800 years, from medieval Europe to the digital age. In the 1340s, some of the earliest international banks on Dubai, the Bardet and Peruzzi families collapsed when European monarchs defaulted on their loans. Ordinary citizens in Florence lost everything. Fast forward to the United States, in the Panic of 1837. Banks lent recklessly, printed questionable notes, and triggered a financial crisis so severe that the U.S. economy fell into a deep depression for 7 years. Then came the Great Depression from 1929 to 1933. Over 9,000 banks failed across the United States. Families lost their life savings overnight with no reimbursement and no protection. Panic turned cities silent. Jump to 2008 and the global financial crisis. Lehman Brothers vanished. Washington Mutual collapsed. Dozens of institutions required emergency rescue. The world learned again that banks, even the biggest, can fall like sand. And just last year, in 2023, Silicon Valley Bank. A single viral message triggered the fastest bank run in U.S. history, proving that even in a high-tech era, banking still lives and dies on trust. The pattern across centuries is unmistakable. Banks survive when people believe they are safe and collapse the moment people doubt them. Underneath the marble, the glass, the corporate branding, lies a truth the industry rarely acknowledges. Banking is not built on money. It is built on confidence. If banks do not store your money physically, and if they can collapse whenever trust disappears, a difficult question emerges. Who do banks protect first? The answer is uncomfortable, but historically consistent. Banks protect the institution, not the individual. They protect their shareholders, not their depositors. They protect the system, not the customers inside it. This is why banks take risks with your deposits, invest in volatile assets, lend aggressively, and seek profit over safety. They operate with the knowledge that if disaster arrives, governments often step in to stabilize the institution even if depositors suffer. History makes this painfully clear. Many people trust modern banks because of deposit insurance (FICI) in the US, protection schemes in Europe, and government backstops across the globe. But most people do not realize this simple truth. Deposit insurance was created after devastating collapses, not before them. The FDIC was created because millions lost everything in the Great Depression. Modern regulations emerged only after the chaos of 2008. New liquidity rules appeared only after the 2023 banking crisis. In other words, banking safety is not natural, it is reactive. Banks are not safe by design. They are made safer only after the system has already failed catastrophically. If the guarantees vanished tomorrow, confidence would evaporate and the system would collapse within days. Perhaps the most shocking revelation is not historical, but legal. When you deposit money into a bank, the law does not recognize you as the owner of those funds. Legally, you become a creditor. The bank becomes the owner. The balance you see is not your money being stored, it is a debt that the bank owes you. This is why governments can freeze accounts in crises. This is why withdrawal limits appear when instability rises. This is why nations like Cyprus, Argentina, Lebanon, and Greece have seized or restricted deposits during turmoil. The system is designed to protect itself before it protects you. If banks do not hold your money, and if they legally own your deposits, and if deposit insurance exists only after disaster, then why does the global banking system keep functioning? The answer is remarkably human trust. Not gold, not reserves, not vaults, just belief. If people believe banks are safe, they are. If people stop believing, even briefly, the bank run begins. Banking is a psychological institution disguised as a financial one, and this is why banking failures look the same across 8 centuries. Human fear hasn't changed. Neither has human trust. The lesson is not that banks are villains or that people should feel fear. The lesson is clarity. Banks are useful. Banks are powerful. Banks are foundational to modern life, but they are not infallible. They are not unbreakable, and they do not automatically protect your money. The safest path is understanding the system instead of blindly trusting it. Diversify your banks. Know your deposit insurance limits. Avoid speculative institutions. Maintain liquidity outside the banking system. Learn how your bank invests its money. Treat banks as tools, not guardians. Knowledge is protection. History is the evidence. And if this exploration changed the way you view banks, consider subscribing to the Economic Rewind Vault, because every episode makes you sharper, more informed, and harder to mislead. In the next episode of Money Myths Rewind, we confront a belief even more widespread, even more emotionally charged. National debt will bankrupt a country. Is it a real danger, or one of the greatest misunderstandings in modern economic thinking? The answer will surprise you. See you in the next Rewind.